Hello, my name is Ren Leggy, Ark's Client Portfolio Manager. Thank you for your interest in Ark's innovation-based strategies via Nikko Asset Management. Today, I would like to provide you with a market overview and portfolio update for those of you that have invested or are considering investing in any of Ark's strategies. First, I would like to provide a brief recap of the market over the last 3 months. So broad-based global equity indices finished lower after a very volatile quarter. The investor sentiment flipped from a potential Fed pivot to a global recession in the face of hawkish central banks around the world. Innovation stocks, particularly those outside of the broader based indices, really rallied during the first half of the quarter before succumbing to the significant selling pressure following Chairman Powell's Jackson Hole speech. At that Jackson Hole speech, Fed Chairman Powell invoked Chairman Volcker's name twice, directly and twice indirectly, the phrase keeping at it. And it emphasized that the Fed will continue to raise rates until inflation falls toward 2% on a year-over-year basis. So compared to Volcker's twofold increase from 10% to 20% in the early 80s, Powell has raised the Fed funds rate 13-fold, from 2.5% to now 3.25%. So in contrast to the Volcker Fed that battled inflation that had been building up for 15 years, the Fed today seems to be responding to COVID-related supply shocks that really surfaced in little or more than 15 months. So in Ark's view, the Fed is making a unanimous decision based on lagging indicators. You have employment and headline inflation, despite significant price deflation that we're seeing in the pipeline. So if you look at post-COVID closing prices, their peaks, commodities are breaking down. We've seen gold drop 18% from its peak, copper down 31%, lumber down 74%. Even agriculture, you have corn down 16%. And we're seeing that commodities that have led the rise in inflation, gold, copper, lumber, are now down on a year-over-year basis. So although previously an outlier, oil price inflation has now decelerated from 99% to 17% on a year-over-year basis during its peak this year. So in our view, the U.S. economy has contracted, inventories have piled up, and long-term inflation fears are overblown. We even have some of the best supply chain managed companies like Walmart and Target that continue to struggle with inventory buildups that have surfaced in April of this year. Nike also reported just recently that they experienced a 44% year-over-year inventory increase as their revenue growth is just hobbling along at about 3.6% in August. So to attract some of these cautious consumers and to clear these bloated inventories, retailers are going to have to slash prices, certainly ahead of the holiday season. So we're also seeing that because the US dollar has strengthened almost 18% this year and more than 26% from its lows last year, there is a powerful deflationary force that is placing significant pressure on emerging and other markets struggling to service dollar-denominated debt. So the combination of geopolitical forces, you have this inventory hoarding, has pushed the U.S. CPI index higher, and that is a lagging indicator. It's at 8.2% over a year-over-year basis, a rate that we believe deflationary forces, both good, bad, and cyclical, are starting to unwind. Even Tesla's CEO Elon Musk and DoubleLine's CEO Jeff Gundlach recently echoed our concerns about risk deflation. Another point I want to highlight is, as measured by the University of Michigan, U.S. consumer sentiment remains at levels not seen since the coronavirus pandemic. We haven't seen this even back in the 2008, 2009 global financial crisis, or even in the early 80s when the economy suffered back-to-back recessions as interest rates and inflation hit double digits. So meanwhile, we're seeing that the U.S. consumer savings rate has dropped to 3.5%, the lowest we've seen since August of 2008. And if you look at that number pre-COVID, it sat around 8%. It peaked close to 34% in March or April of 2020, and now we're back well below the historical average and looking at August 2008 lows. So this suggests that there's very little room, if any, for consumption growth. So this is true demand destruction. So if we're correct in our assessment that growth, inflation, or both will surprise on the low side of expectations, then we think these scarce double-digit growth opportunities could be rewarded accordingly. So the adoption of these new technologies typically accelerates during these very turbulent times as concerned businesses and consumers start to change their behavior much more rapidly than they otherwise would have been the case. So as a result, we see new leadership tends to surface in the equity market towards the end of a bear market. And we think we are starting to approach that based on some of these real-time indicators suggesting potential deflation in the pipeline. Now, I would like to spend a few moments on some of our portfolio actions. You've seen this over the last several quarters. We've been consolidating into our highest conviction names across all of our portfolios. We did most of the consolidation between April of 2021 through March of 2022. And really over the last 6 months, we've continued to consolidate, but at a much lower rate because of all the consolidation that we have already done. There are a few stocks that are held in the Ark subset theme portfolios that we have exited. There's 2 examples that I'd like to highlight because they were due to concerns or from M&A activity. So the first was back in July when we exited Compugen. This was after analyzing the data from Roche's failed skyscraper -01 study that was published back in May of this year, and we have really lost a measure of confidence in their oncology program. Compugen's decision to double down on this program while insisting that it has significant differentiation from Roche's really drove us to reassess our position in Compugen. We're seeing that Compugen, is a small position in many of our funds, and so based on that conclusion of a reassessment, we decided to exit that small position, and that impacted more than one of our portfolios. The second was a positive exit. That was back in September for Signify Health. That's when we exited our position following CVS's agreement to acquire the company for $8 billion, which was just over 30% premium from where the stock was trading prior to the announcement. Therefore, we decided to exit that position as it was really kind of a source of cash to fund new purchases. Now, given the current market environment, we have focused more on consolidation than initiating new positions. However, there were 2 notable additions to the portfolio. The first was Schrödinger, which is a computational chemistry company that's focused on building a very powerful physics-based molecular modeling platform. Historically, they've commercialized its software for academic or pharmaceutical entities using their SaaS model. But as their technology has improved, they have started to sign large-scale drug development agreements with pharmaceutical companies. And so we think that their drug discovery and development software will certainly be a dominant tool for the future of pharmaceutical development. And then the second, which we added in September, was Verb. And they aim to develop really transformative, once and done in vivo gene editing therapies for heart disease. And their gene editing medicines are designed to safely edit the genome of adults and mimic naturally occurring gene variants to permanently lower LDL cholesterol levels. So very exciting kind of work that they're doing that impacts a very large portion of the world's population. So in general, we've been very comfortable with our current portfolio positioning across all of our strategies. So trading activity has been a bit lower over the last 6 months compared to prior years before. However, as we're entering another earnings season, we could see increased volatility, which we may decide to take advantage of either further consolidating or expanding the portfolio depending on the movements in the market. So in summary, we are seeing our innovative companies really take market share from incumbents, and they're still generating, many of them, double-digit or even triple-digit revenue growth in a very low kind of scarce environment. So our stocks are trading at pre-COVID levels, many of them, especially those that are held in our top 10 positions, and they're even trading, in some cases, below their COVID bottom in March of 2020. Yet fundamentally, they're stronger with multiples more revenue, higher cash balances, and longer run rates. So we've been open sourcing more and more of our models and that are within our top 10 holdings to show the market how deeply discounted they are right now. So we think if the Fed is forced to pivot because of the deflation that we believe is in the pipeline, that these stocks are poised for a potential strong rebound. So with that, I would like to thank you for watching. Ark, in collaboration with Nikko Asset Management, plans to continue these quarterly updates and to share our thoughts and portfolio actions. So we hope you find this information and transparency useful as you continue your journey in investing in innovation. And we understand that the current market situation is challenging, but we do believe that innovative technologies and companies we are investing in should provide that long-term growth in the future. And even in the face of these macro concerns, these technologies are continuing to gain adoption and growth. Thank you.